Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So just staring at my new HELOC. Just got it literally yesterday at I think I checked 6 p.m. here. I was like, whoa, I finally have access to it now. And I feel like I put on a power glove on to eliminate this debt using something called velocity banking. And it's a $280,000 HELOC. And now it's time. I'm thinking of all the possibilities. And if you see here, I made my first, well, technically the bank made it for me, the first withdrawal of more than $10,000 because they said, hey, if you withdraw $10,000, we'll eliminate your closing costs. And so I did that. And the funny thing is I could just put this amount that they withdrew for me back into the HELOC, no problem. But it's crazy how they'll eliminate your closing costs if you withdraw $10,000, and I don't think they expect most people just to put it back in. You know what I mean? But you could save $1,000 just by withdrawing 10 in the beginning. So yes. Now, let's get to it. So, what are we going to do today? We're going to go ahead and eliminate debt using something called velocity banking. And a HELOC, a home equity line of credit, is one of our main tools to go ahead and eliminate debt, right? We call it our main operating account. In my sweet, sweet HELOC, I got a $280,000 limit. It's like a giant $280,000 credit card. Now, before we get started, let me just go ahead and ask ChatGPT this. Can you describe velocity banking and eliminate debt with a snap as if you were Thanos? Let's go ahead and ask, right? Whoa, ChatGPT is just really going all in. This is crazy. Oh man, each stone represents. Oh, it represents an aspect of velocity banking. That's crazy. Let's go ahead and read out loud.
Imagine wielding the infinity gauntlet of personal finance, each stone representing a key element of velocity banking. As Thanos, I would face the massive mountain of debt, and with one snap, the process begins. Power Stone, cash flow control. Harnessing the raw power of your income, I direct it toward one mighty blow, the line of credit. Regular expenses bend under the weight of this power, while any surplus cash is channeled with force into paying off debt. Mind Stone. The plan becomes clear. Instead of a mindless grind of minimum payments, I focus on leveraging the LO to wipe out chunks of principal debt. Every move calculated, every dollar a soldier in the battle for financial freedom. Reality Stone, reworking the mortgage. The rules of the game change. Traditional monthly payments? I alter reality by breaking the timeline, making incremental, efficient payments on the principal instead of being trapped in the illusion of 30 years of mortgage slavery. Space Stone, flexibility with the low C. My LOC, my bridge to instant capital, gives me the space to maneuver. I move money back and forth between the LOC and my debts as needed, paying off high interest debts in record time. Time Stone, acceleration of payoff. Instead of waiting years, I accelerate the timeline, fast forwarding to a future where my mortgage and other debts dissolve into nothing. Velocity banking speeds the process so much it feels like snapping away half of my remaining years of payments. Soulstone, the sacrifice required is focus and discipline. Without them, the plan crumbles. But with the right mindset, it becomes possible to snap away all debt, leaving only a free, debtless future. And in the blink of an eye, snap, the mountain of debt crumbles, vanishing into dust, leaving you standing in a new reality where financial freedom reigns supreme.
Yes, financial freedom does reign supreme. So let's go ahead and get started with this thing called velocity banking. What is velocity banking? All it is a debt payoff strategy using your line of credit as your main operating account. Okay, and you only need two things to do it. Number one is a budget, and then number two is a line of credit. So you saw that sweet, sweet $280,000 home equity line of credit. Well, we're going to assume that we have access to it. Okay, so right now that interest rate that I have is actually 8%. 8%, and I have access to $280,000. Oh my goodness. Okay, so now we're going to deal with a somewhat higher income individual, right? $7,000 of income, $6,000 of expenses. Not a lot of savings left over because we got 3 credit cards, 2 auto loans, and we got a $400,000 house. So I'm not a big fan of houses in the 400 and above range, especially in the Georgia area, because I feel like there are plenty of houses in the 300 range that would are comfortable to live in and would make you debt free. Now, if you had a $300,000 house in California, that doesn't even exist nowadays anymore because every house there is 1 million. But here in Georgia, I think 400 above, a little bit too much, but we're going to go with it for this example. Now, let's calculate how much debt we have. Let me just do this. So with the credit card, I'm just going to sum it up. It's 5 plus 8, 18 plus 12. So that's 35. Oh, 35K. So I've updated these numbers. $35,000 of credit card debt. And how much other debt do we have? So it's 24 plus 15 plus 400, right? So it's 439 plus 35. So that's $474,000 of debt that we're going to snap away with our reality, no, infinity stones, okay? So let's go ahead and do this. So how do we do velocity banking? What's the difference between the average American and the velocity banking? Well, it's simply just this. The average American uses their checking account as their main operating account, whereas the velocity banker uses their line of credit as their main operating account. See, checking account, the main operating account here, line of credit, the main operating account. And so in order to do this, we have to assume, or we can assume two things, but what's really important is once we have the line of credit, number one assumption is that we have the same income, and then number two, and this is what we have to do, is we're not going to have any savings. And this is a shocker to most people. Like, I'm not going to have any savings? Oh my goodness. Because in order to snap away that debt, we're going to have to put all of our money into our line of credit to eliminate that debt. And as you can see right here, $0 beginning balance, $0 ending balance, right? And this is very hard for most people at all income levels, okay? So let's go ahead and do this. And I am going to copy and paste. So what we're trying to do is we're trying to eliminate every single debt here in the most efficient way and still maintain control of our cash flow, right? This is what the main problem with most people is that they know how to pay off debt, but let's say they use their savings to overpay a mortgage, then it's like, what do I do? Like, how do I do all this? Okay, so now the end goal is to make sure that all of these debts go to zero, and the only thing left remaining is our other expenses that we always have to pay that are not related to debt. Food, gas, insurance. We always have to make enough money month to month to make sure that those are paid, and this includes taxes as well if you're going to spread it out monthly. So let me go ahead and redo this. And instead of savings, we're going to have something called cash flow, right? So cash flow. Now you might be thinking, you're on crack because the savings number and the cash flow number is exactly the same. And we haven't finished the final step yet, which is to make our line of credit as our main operating account. In order for us to do that, we have to move some debt. And the easiest debt to move into the line of credit is the credit cards, right? So if we sum this up, we have $35,000 in credit card debt, and let's go ahead and move that here because we got this sweet, sweet $280,000 home equity line of credit available for us. And again, what is a line of credit? It's all it is, a financial tool where you can borrow money, pay back, and use it over and over again. That's what a credit card is, but the beauty of this home equity line of credit, again, you're putting your home equity as collateral, and anytime you provide collateral, the banks give you better terms and rates, right? And more limits anytime. So with this home equity line of credit, let's say I decide to borrow, I don't know, $50, and then the next month $50 is due. I could just borrow the $50 and pay it back. Payment satisfied. That's crazy. I had no idea tools like this existed before I ever learned velocity banking. It's like, oh my goodness, I want all of it, right? And that's why I have over $516,000 in lines of credit right now. Right now, I have over $516,000. Okay, so now this is what we're gonna do. So let's go ahead. Well, we already done this. We've moved 35 grand into that home equity line of credit, and now by simply shuffling debt, we didn't do anything else. Guess what happens to these payments? Oh my goodness, they go to zero, and we went from $723 to $1,900 already. And so now this is kind of like the final step of the velocity banking strategy. You put your entire 7 grand into the line of credit, you take out 5,000, and then after every single month, this is going to be how much your debt is going to be eliminated by this cash flow number plus some interest, right? So let's go ahead and do that and just calculate the next month's balance, or the next month plus one, the next month's balance, which is the previous month's balance plus the previous month's interest, minus this cash flow number, 1903.1, right? And then what we do is we calculate the interest by taking the average daily balance. And we're going to go ahead and do that. Average, multiply it by the interest rate, which is 0.08, right? That's 8%. And you might be thinking, I paid 2,700 a month on interest on this 8%. No, it's actually, so here's a crazy thing. This is quoted annually, right? But the interest is calculated monthly, and so you got to divide by 12. So you only pay 226. Not as much as you thought, right? So that's why I've always been afraid of like 30%, 8% APR, because like, oh my goodness, you got to pay 30% a month. And there are plenty of people who think that way too. That's why they're afraid of credit cards, right? But the thing that gets you with the credit cards is just carrying a balance and making the minimum payments, which is what we're not doing with both our credit cards, lines of credit, and or credit cards and loans, right? Okay. So now we pay this off in about 20 months, not 20 years, that'd be crazy. 20 months, right? And that was pretty simple. So 20 months to pay off 35K. So we just write our milestones here. 20 months to pay off 35K, and that's 3 credit cards. And now what we do is we add that to 2 auto loans, and auto loan one, auto loan two. We'll just assume that this is like a used car, right? 15%, and usually the used cars have higher interest rates, right? That's my understanding. So let's go ahead and figure out after 20 months what's going to be the balance of these loans. And luckily, we have this loan calculator here to figure it all out. So let's go ahead and open that up. Here is our loan calculator, right? Our loan calculator. And all we got to do is just type in the current month, and then it will spit out the current balance. Isn't that crazy? So let me just kind of go back here as to, because I have a fish memory and I can't remember when I switch tabs what's what. But 20 months, so I'm just going to put 20, 20, 20, right? And then right here, we can see how much interest we've paid throughout the life of the loan up to that point, right? And then you have this thing called a cash flow index. Now, what is a cash flow index? It's just a ranking system that you can use to figure out which debts to pay off. And the lower the number, that's the one you want to pay off. And you might be thinking, well, what's the big deal? Well, here's the thing. The traditional debt payoff criteria that I've always used, what I originally learned, is find all the debts that have the lowest balance, highest interest rate, and highest payment. And whatever fits into that category, or as much as those 3 categories as possible, you want to pay off. And then random people, I'm not even kidding, started sending me their spreadsheets, and kind of like this, where it's like you got 22 debts, like all these interest rates, all these payments. How do I figure out which one to pay? And they're all over the place. And then once I understood the cash flow index and understood how to rank them easily, oh man, that was a game changer. That's when I started falling in love with it. And I actually did this scenario in a live stream. Only 99 cents. So if you want to join the YouTube channel, 99 cents, and you get access to the once a month exclusive live streams for channel members. So that's why I started using cash flow index. And anything below 50, those are good candidate loans to pay off. So why don't we just pay off these 2 loans, right? And let me sum them up. So it's G2 plus G3, right? G3. And that's 27K. So if the CFI is usually under 50, we're safe to pay them off. And let's go ahead and pay them off, meaning that we just transfer the balances to that line of credit. We'll go ahead and do that. And let's do that right here. So plus 27455.69. Okay. And then simply by transferring into that line of credit, these both go to zero, and it's like, whoa, we went from $723 to $2,673 of cash flow in 20 months, so less than 2 years. So pretty good from kind of being semi broke. Because if you're making $7,000 and you only got less than $1,000 left over, I don't know about you, but I'd be kind of nervous, right? Even grocery bills nowadays are like $100 every time I go, right? So you got to have a little bit of cushion, and those cash flow sucking debt payments, they're the reason why a lot of people can't sleep at night, right? And we're gonna eliminate that with the snap, with our debt infinity stones or velocity banking infinity stones. All right. So now let's go here, and we're gonna. Oh shoot! Did I screw up? All right. So now let's go here, and now we're gonna update our cash flow from 1903 to 2673.26. Okay. And let's go ahead and do that and see how long it takes us to pay off those two auto loans. And I think we just got one more month. No, we got 2 more months. Okay, so now it took us about 31 months. So let me go ahead and do that and see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So about really 11 months, a little bit less than a year to pay off the two cars. Two cars, is that crazy? So we got that covered. And now the last thing here, and I'm sorry, I'm going all over the place. This is 30 months, no, 31 months, okay, 31 months to pay off the two auto loans. So 31 months, and so it's 24 plus 15 plus 35. That's 74K. 74K. Okay, so we got that. And then now, what's the balance of the mortgage at 31 months? Okay, so 31. Let's go here, and we're going to figure that out. And $382,000. Look how much interest we paid, right? So we paid 45 grand, and 400,000. How much is 400,000 minus 382? About 18 grand. So during the first 31 months, we paid so much in interest, and we only paid 18 grand of the loan balance, aka the principal, right? Um, it's just devastating to see how much interest we pay on a 30-year mortgage, even at 4.5%, right? You're just kind of literally throwing money away. And there's a reason why the bank loves it when you take these out, just because they're such a moneymaker. And the crazy thing is that they actually don't keep the payments. They just sell them off just because the origination fees, I think, are so good. That's my understanding. That's why anytime you get a new mortgage, you ever notice you get a letter, oh, it's already been sold off to someone else, just because there's only a limit of number of loans that they can originate and hold. But just originating them is a big money maker as well. But whoever's holding the payments, man, look at them, they're winning, right? And we're going to eliminate this debt. Now, one note I want to make about the mortgage is that it's definitely the last, what's it called? Loan or debt you want to pay off, because again, according to the cash flow index model, the higher the number, all that means is that, for the amount that you're borrowing, the payment amount is so low. Again, if I'm gonna pay off this $10,000, I get $300 back, but in order to get $2,000, I have to pay almost I have to pay 380 grand. So paying, think about, let's say you paid someone 380 grand to give you $2,000 a month. It's like, well, that's not that much. That's kind of crazy, right? Like that's really um that's a pretty terrible return, right? And so but the thing is that even though it takes up a little bit of payment amount, you end up paying a huge amount of interest. So what we're trying to do is, yes, we're going to get rid of the debt, but we're going to get rid of it last, because we need to use all of our short time and be as efficient as possible to get back the rest of our cash flow. Okay. And so now at this stage, you have two options. Okay. First option is directly putting the savings into the mortgage. Now, how many people do you know that if they have $2,600 in savings, which is honestly not that much, if they have that much in savings, how much would they put into a loan directly? Like, I'm going to pay the monthly mortgage payment, which is 2 grand. Oh, I'm going to put an extra 2,600 on top of that. Like, they know it's going to pay it off earlier, but they're not going to do it. Just like with student loans, right? How many people do you know who went to law school, and I know a few people like this, who did the income-based deferral programs, or I forget what it's called, IBR, income-based repayment programs, where they lowered the monthly payment because they got into cash flow issues. And then all of a sudden, like a couple of years later, wait a minute, I've been making all these payments, and then the loan balance grew, right? That's because people know that when you put your savings or whatever you have directly into the loan, it destroys your cash flow. So what we want to do is make it easy for us to pay off our loan quickly and still have control of our cash flow, right? So what we do is maybe just kind of do this chunking method and just move parts of the loan into the line of credit. Okay, just parts of it. So usually the rule of thumb is just move whatever's your paycheck amount into the line of credit, or we could use a number similar to that. So if you want to just do kind of like $10,000 chunks, it's not going to make that big of a difference, because what really matters is that cash flow number. But let me just put this number here, 10 grand. Okay, so 1, 2, 3, 4. How long did it take for us to pay that 10 grand? 1, 2, 3, 4, about 4 months, right? And you can see here that just to pay 18 grand in 31 months, that's a no bueno, and we paid 45 grand in interest, right? So we just kind of use this as an a way, as a step to make it easy to overpay your principal without thinking about it, right? And maintain control of your cash flow. Because I'm going to tell you, there's a reason why, even though paying your mortgage directly with your savings is the default option for everybody. You don't need a line of credit. Getting a line of credit is work. Let me tell you something. I got anally probed for this $280,000 line of credit. Right? I got anally probed, or financially anally probed. Let me say that. Is that inappropriate for the kids? I probably should say financially probed. But then sometimes I hear like clowns and aliens might scare kids. But okay, so back to my point is that you got to get really good finances in order to qualify for this. And so, people say, well, anybody can get a line of credit. That's not actually true. Banks' ideal customers, people who are making good money, and they have a slightly potential um, chance of mismanaging it, right? That's like their best customers. It's not people who are like suck at money or who are poor. That's not it at all. So what you want to do is you kind of want to be the guy who, instead of like being like making good money and kind of sucking at managing it, just make good money and then just be really good at managing it, right? So I don't know why I'm blabbing on, but again, so what we're gonna do is we're just gonna do the quote the chunking method to pay it off. And luckily, it's somewhat complicated to calculate, because if you do the chunk, right, it's not, you can't accurately calculate because you're still making the monthly payment. So some of the principal is still being attacked while you're making the monthly payment. So it's not just in every chunk. So let me just kind of go in here and do this and open up the velocity banking calculator. And I've done this for so long that I could probably guess that because it's a $400,000 loan, at least probably going to take me, I don't know, 7 to 10 years. Usually 200 and $300,000. I kind of know that it's going to be about like sometimes 4 to 7, but 400,000 feels like it's going to take way too long, or at least way too long for my taste, because I paid off my mortgage under 3 years, believe it or not. But so let's go ahead and open that. And wait a minute. Did I open this correctly? I think I opened the wrong spreadsheet. Hold on one second. There we go. There we go. I got my spreadsheet up now. I got the numbers already filled in. So $400,000 loan, 382 currently, 4.5%, $7,000 chunk, 8%. And then now we have this nice cash flow, $2,300 in living expenses, um, without the loan, right? So with the loan, it's like 4 grand, but the loan is calculated here. And look at that, a little bit above 7 years. I kind of knew that, right? 8.2 years. So am I happy with that? I think most people would be, but because I paid off my mortgage into 3 years, I'm like, oh, not good enough. I'm just kidding. But in general, I wouldn't buy a $400,000 home. What I probably would do is, if I were to live in a $400,000 home, I'd probably work my butt off to get a distressed home in a nice area at a huge discount, and then I would fix it up, right? You save a ton of money doing that. And that's really just what a fix and flipper does, right? You find a nice home in a nice area with a huge discount, but instead of just selling it to other else, just keep it and live in it. right? What do you call it? House hacking? I might probably would do that, but I would probably never buy a retail $400,000 home for $400,000. And folks, there's a reason why 90% of millennials regret buying their first home in 2024. They overestimated themselves, right? But 8.2 years, that's not bad. Okay. That's not what I consider a snap, but it's a snap for most people. Okay. So let me go ahead and record that. And we're just going to do this. And now let's just do this. So 31 divided by 12 plus 8.2. 10 years to be debt free. So 10.7 years debt free, right? Not bad. Not bad. So that's $474,000 of debt. And we're good to go with our velocity banking. I want to say the HELOC is the Infinity Stone, but it's not. The strategy is the Infinity Stones, and HELOC, I think. What did ChatGPT say? Let me actually uh, go back to ChatGPT, and then we can see right here that ChatGPT says the flexibility with the line of credit is the space stone, right? So I guess that's what it would be. The line of credit, that home equity line of credit, this one right here represents the space stone, and then velocity banking is all infinity stones combined with the gauntlet, right? So, man, I remember when I saw that, I logged into a website. That's what I thought about. I literally just thought, I have the Infinity Stones. Okay, well, that's it for today. So happy Saturday, just our daily velocity banking practice. And have a great day and speak next time.